Good day, ladies and gentlemen, and welcome to the show on this Tuesday, the 5th of July, 2022. I hope you guys had a good 4th of July. A little bit of, I'm not going to call it a hangover, but a little bit of carryover from the 4th. But in a good way, but not a hangover. I don't have a hangover. Anyway, let's get started. Let's get in there and take a look at what's going on in the markets today. First thing I want to take a look at is the silver price. $19.20, down 78 cents on the day so far. You just take a look at commodities right now, and what we're seeing is a collapse in the markets. Could it be leading toward the credit freeze that I've been talking about? Well, yes, maybe. But how far are we through all this? I would say we're more than 60% of the way through to where the Fed's going to capitulate. And yes, we could possibly have a credit freeze toward the end of this, when it really starts to do collateral damage within the financial system itself. But we're seeing down 78 cents on silver price. And let's take a look at gold today. Gold is down $41.30. Now, if we take a look at cryptocurrencies, 882 billion, 876, 878, and we're looking at a Bitcoin price of 19,424. So cryptocurrencies are suffering real bad too, along with gold, silver, and the stock market. Everything's going down right now and simultaneously. We're taking a look here at the Dow Jones Industrial Average. Let me refresh the page. It's down 651 points on the day so far, or just over 2%, 2.1%, at 30,445. This is exactly what you can expect. I told you guys that this was a bear market rally, and the bear market is going to end when the Fed capitulates. But you know what's really dangerous about all this is right now is we see bonds and rates on the 10-year yields dropping, and the central banks are doing intervention in the bond market, in the debt market. And even with this this is what's so dangerous about this is even with this intervention, we're still seeing the markets in general roll over. And this is tremendously inflationary, this intervention that the central banks are doing in the debt market. And so the markets in general are overlooking that, which is very inflationary or tending toward inflation. But see, they started it. It's just like kids in the schoolyard, you know, you get a bully and stuff, and he'll say that he started it, and the other one says he started it. Well, the Fed started all this, and the markets are now involved in it. What's going on, and the situation is, in other words, it's spiraling a little bit out of control right now within the markets, but that control can be brought back. It's got to be brought back in one way and one way only. Tremendous amount of money printing has to bring that control back. So we're looking at a market that's down 600, and I told you guys this is going to continue. It's not going to stop. It's not going to abate. It's going to continue. It's actually could get a lot worse until they decide, hey, you know, maybe we've made a little mistake with all this quantitative tightening, you know, and raising interest rates and so on. Maybe we went a little bit too far, because aren't we the only guys that support these markets anymore? I mean, aren't we the only guys out there who really put the debt in this debt cycle, you know, and in the debt markets? We're the people that produce the money, and we're the people that pumped all this up, and now we're going to pull that support away. What do you think's going to happen? Well, it's happening right now. Well, let's take a look now at crude oil, 103. It's down $5.33 on the day so far. And see, these are big drops in almost everything. And of course, when you get things dropping, you're going to have the dollar go up on the US, on the DXY, which is what it's doing today. Take a look at the MOVE index. 144.17. Now see, the volatility is returning. I'm expecting this could really shoot up, this MOVE index, very soon. This is dangerous. It's your credit markets. We could be heading for a suddenly of situations very similar to 2008 right now. It's right at our doorstep. We're at the doorstep of this happening right now. Looking at what's going on in these markets this morning. You know, I mean, this is sobering. This will sober you up. If you're not sober from July 4th, this could really sober you up fast. Take a look now at bonds and rates. We're seeing that the bond yields on the long end here, U.S. 30-year is down 8.6 basis points at 30.04, and the U.S. 10-year is down to 2.79. Now, you see, they're kicking it into high gear, controlling this debt market, thinking that they can control the system that way. And normally, yeah, he who controls the debt market generally would control the system. But right now, they've created a storm within the system. And so they're trying to control the storm by one lever or one gear that they're using. It's very effective, but you know, this thing is going to continue to roll over until they really come to the aid and rescue of it. Let's take a look now at the dollar index. It's 106.73, and you can see it's been climbing all day. Strong dollar. We're right in the middle of the, you might call it the dollar milkshake, because, yeah, you know, you cut off credit, and you're cutting off the source of dollars, you're going to have a liquidity crunch. And in that liquidity crunch means you now have enough dollars, and the dollar's going to go up, and everything else is going to go down. That's what we're seeing happening right now in real time. But this can't last for very long, because it'll ultimately destroy the system, and they can't let that happen. That means printing more. So, I mean, this is just the worse it gets, the more they're going to print on the other side of this to try to maintain and bring the system back when they have it tip a little bit too far. Okay, guys. Thank you for listening to my show this morning. Like and subscribe. We'll catch you guys in the next episode. Bye-bye.